Hi, this works? Oh, perfect. Thank you very much for being here, and I'm very pleased to moderate these panels to talk about the growth of stablecoins in Asia and partnership we can have in banking and how it's going. First, I would like to thank all our panelists who are here, starting with Yamkin Chan, which is a VP and Strategy Policy Officer at Circle. He used to work on Google, also the White House and US Treasury Departments with a strong background in economy. Further, we have Markus Franke, which is the CEO of Mento Labs. He ran with the Stablecoin platform on Silo, and he's also coming from the traditional finance and with economist background. Then more on the product side, and with a strong knowledge on this noise, we have now Ashok
Venkateswaran.
Venkateswaran, sorry for that, which is leading the APAC blockchain and digital assets for MasterCard. Then we will finalize here with Aishwary Gupta, which is an ecosystem business developer at Polygons Lab, and also strong experience in FinTech and blockchain specialists on that. So thank you very much for being here today. And let's start with the first question. It will be very interesting to see the growth and the potential. For me, it's important to understand the landscape of the stablecoin and how what can bring us straight or also as benefits for the futures in Asia. Maybe we can start with regulatory environment backgrounds to know where is stablecoins currently, what is the landscape. Maybe Kinshal, you can start it.
Sure. Well, thanks for having us, and thanks for the organizer for putting together this event. For those of you who don't know, Circle is a Web3 infrastructure company. We're probably most well known for USDC, the stablecoin, but we also have Web3 services that support companies moving from Web2 to Web3. I think there are kind of three things I think about, right, on the overall landscape. The first is that over the last year, people have talked about a crypto winter. In 2023, we're actually in a regulatory crypto spring. This year alone, we saw passage of regulation in Europe with MiCA. We have clear rules here in Singapore. Japan has clear set of rules and a stablecoin framework also in June. Hong Kong will have something that comes at the end of this year. And then in the US, despite all the noise and ruckus that's happening, there are bills that are out of the House Financial Services Committee that are being debated this month in Congress. So we're actually in a crypto spring. The second piece is we're going to see this greater adoption of from Web 2 to Web 3, in part because the technologies are getting better. We're abstracting a lot of the complexity of blockchain so that it kind of falls to the background. Things like programmable wallets, smart contract platforms, they will help traditional companies make it easier to move to Web3. And for those of you who are in Singapore, you may have seen the news yesterday. We had partnered with Grab to launch their Web3 wallet powered by Circle. So we're going to see some of that happen in this next phase of growth.
Cool. Yeah, thank you. These are really, really good points. I actually want to double down on these. I had the same points in mind when thinking about it. So yeah, first of all, also thank you everyone for having us here. It's a great event in a great historic location here in Singapore. So that's amazing. I'm working on Mento Labs, which is a stablecoin platform on Celo. So we build infrastructure for stable assets on Celo. And I fully agree with the points that Yamki mentioned, that with a regulatory spring, for example, MiCA in Europe, we now have regulatory clarity also for traditional companies to go into Web3 space. On our side, we have been working a lot, for example, with carriers, with Deutsche Telekom and Vodafone and Telefonica and others. And for them, it's very, very important to have that regulatory security that they can actually engage with our ecosystem. So that is great for us. Also, other traditional companies are now moving in the space. On our side, we also had an announcement yesterday. We announced together with Opera the MiniPay wallet that Opera will roll out across Africa on Celo. And seeing like a traditional or more traditional browser company to go into this space to offer a very easy to use wallet, end user focused, to get basically to adoption with real end users is something that is new, that is now coming in this, like you could call it bear market, but it's actually a market with new records in terms of active developers, in terms of active wallets, in terms of transaction on blockchain. So despite bear market prices, I think this industry is actually growing a lot. And therefore, I think now the infrastructure and the regulatory clarity is becoming better and better so that we actually can talk about growth in Asia, in Africa, and other regions around the world.
Before to move more on the product and to understand a bit the bridge we can have, I have another question on the regulatory side. Where stablecoin compared to other crypto will be an help, or how it can be seen? Because we noted that we have a lot of back and forth towards the Fed, who certain times after the collapse of FTX or others big exchange coming. Where stablecoin is feeling, because you know that you have a lot of volatility with others crypto, why stablecoin, depending on what is back, can help. Why you think, and where we have a good environment for that?
I think it's a regulatory question.
Yeah.
So I'll let you take it.
Oh, I guess the guy in the suit is the one that's going to take the regulatory questions. So I mean, as I mentioned before, we are getting greater regulatory clarity. You mentioned the U.S. in particular, and there was a very intense debate at the House Financial Services Committee on both the market infrastructure piece of crypto as well as on stablecoin. But there was actually less debate on a stablecoin, which tells you that there's more agreements there than actually on the virtual asset side. So that's something that's positive. What the U.S. is trying to figure out really is an age-old question that has really dogged the founding of the country, which is the power between federal and state. Who gets to have the final say? Who manages systemic stability? All of those things, and that's where the major challenge is in the U.S. As you know, in the U.S., we have 50 states. We as Circle, we are licensed in 46 of those states. The other 4 doesn't have a money transmission license requirement, so the other 46 do. And it's the same way that an Apple Pay or a PayPal is licensed. So that's the base layer of how we're licensed. And then we have the BIT license in New York, the New York DFS. So that's the virtual asset license equivalent, but it's only available out of New York DFS, which is essentially the most advanced virtual asset regulator in the United States at the moment. And they're sort of our primary regulator on how we're set up, and we're the first company to get that BIT license. Now, the question I think in Congress is, if you are licensed at the state level, do you need to also have a federal level regulator? And probably there should be, and that probably should be the Fed. And what's in the bill right now is essentially some of the base standards that are set, and the Fed, what is the power? Can they veto the state level license, or do they have some sort of dual supervision in some way? I think that's the part that gets figured out. But I think the clarity, what you're seeing is greater clarity all around the world, and US has to play a role there. And then the other part is there's actually a flywheel that as these rules become clearer, you see more and more Web2 companies move into that direction. So Grab was just one example. We also did a deal with Mercado Libre, with Mercado Pago, where they're using USDC as a remittance currency in Chile. Right, another real world example. Visa. I know we have MasterCard on the table, but we're open and interoperable. Visa announced that they're doing a pilot on cross-border settlement with USDC, and they're saving so much time and cost in that. So as the rules become clear, you have more Web2 businesses that will adopt, and I think we're on a smoother path on stablecoins.
Maybe to add a bit from a European perspective, what you can see, for example, now in MiCA is that in MiCA, 3 different categories of assets are defined. One is the e-money category, when a token is something like fiat, and it's basically digital money. And then certain rules and regulations apply, for example, on the collateral of these assets. Then there are asset reference tokens. You could see asset reference tokens similar to e-money, but maybe different features, not tracking one currency, but for example, a basket of currencies, like certain settlement tokens. Also a great area that this technology actually enables to have like dedicated settlement assets on a blockchain. And then there's this other category where all these other assets fit in that could be volatile, that maybe are governance tokens, utility tokens of different kinds. And it's good to have this framework because then users can actually interact. They know what the asset is they are holding, and companies have this regulatory clarity to act in this industry.
So, if I just add, so I think the regulations gives us clarity on when we build product, right? To how we want to support some of the ecosystems out there. Like he mentioned Visa. We're looking at remittance type use cases where we can actually use USDC to move monies across some of these primary corridors. But also the user base, because the regulations increases, because now you can have banks who can participate and other regulated entities like MasterCard can participate in this ecosystem where we didn't have clarity before. Now we have a lot greater clarity.
I would also add, touching on both your points on like MasterCard's usage and the different frameworks, is that one, and it touches on your question, right? There are different type of digital tokens in the world. It's laid out in the FSB framework that became the MiCA rule. And then there's a bucket of stablecoins. But the fact is, not all stablecoins are created equal. They're different in how they operate. And you mentioned there are, algorithmic. We've seen an example of that before last year. We don't know what happened there. We have multi-asset, and then we have single currency, single asset backed. And essentially, what we see, if you were to kind of walk around the world, there is convergence around the single asset or single currency type of stablecoin. That the standards are coming around to, you have one denominated currency, one denomination, backed by assets of the same denomination, else you're taking some sort of implicit FX risk, and you have to have high quality liquid asset as your reserve, right? So that there's not liquidity risk that you're taking on implicit in that stablecoin. It's clear in terms of how Singapore is looking at it. If you look at the new stablecoin rules, they were very, very clear. There's a single currency stablecoin. The Hong Kong MA consultation were explicit that there are different type of stablecoins, but the one that they're going to license are the ones that are single currency. You see the same thing in Japan. I think there's a theme around like what at the moment regulators consider the safest and most reliable and has the best protection for consumers going forward.
Thank you very much. Maybe we can drop on us more on the product side and this. What will be the opportunities using the stablecoin, or what the stablecoin can bring to Asia?
That's a very broad question, but we're exploring a number of different use cases. As I said, there's obviously the basic ones like remittances that we're exploring. We're also exploring stablecoins as potential settlement. Right? Can we use stablecoins to settle intrabank or on a larger scale as we're building solutions for this? So, like we're building a tokenized deposits platform where an FI could come in and tokenize their deposits and move money from one to another for basic DVP type use cases, right? And you could use potentially the stable coins as an underlying settlement currency, right, for moving across banks. Now, it also depends on how comfortable banks are to use stable coins as a settlement currency, and also the availability of the liquidity to do so. But those are some of the things which are coming to us. And in addition, because of these new regulations that we just talked about, more people are coming forward with use cases that we can actually build on our network, right? Because at the end of the day, we are a network and we're trying to provide services to our customers downstream.
Yeah.
I think just to add on, like from a perspective of stable coins, one of the things that I've been noticing is like the two theories that I have in my mind. One is like when we talk about payments, essentially like you need to have more stable coins, more in the sense of like not just US denominated, but like the currencies which are there like in Asia and all these regions to come on chain. Like see, so if I just talk about facts, like a lot of these currencies are not on Swift, and it becomes really difficult for those countries to actually go out and trade because they are not on Swift. So that is one problem. Second problem is, like, even if you look from a perspective of like PVP, payment versus payment transaction. So on a daily basis, there's somewhere around $7 trillion that move for settlement. And when this money moves, there are almost like 70 plus currencies which are there. Out of this, only like two-third is like covered through PVP and some other contractual obligations, and these constitute only 18 currencies. So almost like one-third of the total money that is moving daily across the world is not secured, is not insured. It's is always at risk, whether that counterparty will settle for you or not. Now that is where I think when you talk about Uniswap, right? Uniswap is a PVP, payment versus payment, which means like if you're swapping one token for another, you know you will get the other token, right? You don't have to get into a contractual obligation and say, oh, you know what, like we are doing this contract, we will send you the token when we receive, like the other part will move sometime later. So that is where the power of blockchains come into the picture, and that is where when you have more stable coins come into the picture which are not US denominated, that is where like you go out and create that kind of an environment where money can freely flow. And when that money can freely flow, essentially that is where your FX on-chain markets get created, and that is, I think, the biggest opportunity in Asia, where you can actually go out and bypass Swift from a perspective because they don't have those currencies, and still create an ecosystem or an environment where all these things can flow very easily at a cheaper rate, at a faster speed. And it goes out to one more thing, which is like risk appetite. Like a lot of banks and financial institutions have a certain risk appetite when they deploy capital, and it is very difficult to always hedge all of them, right? Like I think I get that experience from American Express, like when we used to settle a lot of money there. And all these things, so when you go and create that kind of a market which is open source and is readily available, you also actually go out and create that, invite those kinds of people who are ready to take that kind of a risk. Like if you look at Nigeria, like I'm just giving an example, like when does Nigerian rand have liquidity? They have it when they get a grant from IMF or something like that. But on a regular day, if you want to trade them, it's almost impossible without like a very big a gap into the prices. Even like if you look at the standard markets, once your New York market closes, and then before the time your Hong Kong market opens up, there's so many flash crashes that happen. Like you literally are losing like 5, 6, up to 9% just on a currency swap on a weekend. So those kinds of things can only be solved when you create these things on chain and get those things like running on a blockchain. And that is like I think the biggest opportunity that we have here.
I really agree with your points, Aishwary, that especially the first point that offering local currencies and access to different currencies, not only, for example, dollar-based stablecoins, is important for users for many different reasons. Merchants, users have to pay taxes in local currency. They have to maybe purchase their input factors in local currency. If you're in countries, you mentioned Nigeria, where you have a deflationary currency, if you're a small business and you need to get a loan, it could be very expensive to get that loan in a very stable currency like the dollar. So giving access in different currencies and in different local currencies is something that we at Mento Labs want to focus on. Obviously, on the dollar side, for example, we have great stablecoins that exist, and a large part of the assets we are building or our products are actually collateralized by USDC and other assets. But we want to give access to also like smaller and more local currencies, and we want to do that not only in Africa. With the Opera launch, currently our focus is a bit on Africa, but yeah, want to explore the same actually also for Asia, giving access to different and also local currencies.
Yeah, I think both this panel and the previous panels talked about how stablecoin actually has product market fit in outside the US, interestingly enough, right? That US is sort of the most advanced, but like, the dollar already is in use there. There are a couple of things I would highlight that why there's a product market fit in Asia. Number one is trade, cross-border trade, right? And Ashok talked about this. But when you look at all of the Asian economies, the trade to GDP ratio are much higher than the US, which is actually largely a closed economy, or Europe when you remove intra-Europe trade because they're on the same currency. That's one. The second part is, and touched on it, was trade finance. And there's actually a company outside that does trade factoring, right? They essentially buy invoices and then have lenders who have USDC that they want to get a yield on and be able to lend that to the merchants on the other side. And the Asian Development Bank, ADB, estimated that there's $510 billion worth of trade finance gap. Trade that did not happen because a merchant is unable to get a letter of credit or insurance or able to pay for the working capital because you are essentially paying for the goods and not receive the money yet from your customers, right? When you think of the businesses in Asia, it's truly global. You could be sitting in Singapore on some sort of e-commerce platform. Your customer is in Japan and you're taking yen, or in Korea and you're taking won, and your vendor is in Vietnam, so you have to pay them in dong, or in Thailand, you got to pay them in baht. All of these are costs for all merchants, but it's particularly hard for small and micro merchants. So I think blockchains and stablecoins in particular can help solve some of this. And the last piece is remittances. We touched on this a little bit, and the World Bank had estimated that on average, to remit $200, the cost is around 5.9%. So it's about, so $200, so $12 roughly to move $200. And this is hits the most vulnerable in our society, who are usually migrant workers that are moving from country to country, finding work and sending money back home. So how do we lower that cost and make it safer for them and provide them that reach that they can send money to their loved ones in a village which may not have a bank branch? How do we solve that problem? And I think stablecoin has a real good product market fit there.
And on these costs, I'm sorry, actually on these costs, and this is just an average, and this average has a lot of markets where it's like relatively cheap. If I send, I don't know, money across border from Berlin to Paris, it's super cheap. And this is in this average. But if I send money from Berlin to Nigeria, then it costs 20%. And therefore, like these costs, especially where people are most vulnerable, are incredibly high, and this is, I think, where we can change a lot.
We're at a Stablecoin Summit, so I should agree with you, but I don't agree with your point about every single country needs to have a stablecoin in this local currency, right? I think we have a very strong banking infrastructure in Asia. You can use a digitized deposit where it has all the attributes of a stablecoin and can move money to within the existing infrastructure without having to get a new wallet infrastructure in place. That could be another way, because what ends up happening is that if you have multiple stable coins in a country denominated in that currency, now you've got to have interoperability across those stable coins and create additional wallet infrastructures. So if you're trying for adoption, an easier way is potentially to do a bank deposit, which is digitized and can move across the existing networks. Now, I'm not saying stablecoin is a bad idea. All I'm saying is that the stablecoin has some use cases which are very valid, but if there's one or two stablecoins per country. But if you have a number of them, now you're just kind of aggravating a problem and not really solving it.
That's true, but also on this like infrastructure side, a lot of these systems actually don't talk to each other. I mean, if I'm in Europe and want to send money to New York, they are like both very advanced financial economies. It takes like 4 days. If there's a bank holiday in between, it takes 5. And this in an age where I can also send a payment in USDC or CUSD, and it's there in 2.5 seconds.
True, but sorry. I mean, in a domestic network, you can move money pretty efficiently within the domestic payment network, right? Now, when you talk about internationally, even New York to Paris, you still have to off-ramp that USDC because the guy in Paris is looking for euros in a card format, right? When I say card, I'm not talking about a MasterCard. I'm talking about like in a digital format that you can actually just tap, right? You still can tap USDC and buy your baguette.
So basically, you have to integrate our assets, so then the guy in Paris can tap.
Well, eventually, yes, but that's not the point. The point is the fact that you still need liquidity in your local currency to even use it. So even if the money shows up within 10 minutes, you can use it. Right, Piyush. There we go. Right.
Yeah, I think I agree to that portion. The only thing that happens is like when you go out and say, so there are two things, and one of the things comes from like one of the concerns that even the Indian government has, is like when you have a certain currency becoming like again the global currency, global reserve, then you're not only just increasing the risk of one country, you're trying to increase the risk which will be flowing from that country to a lot of other countries, and and that is what a central bank in India is saying about why do you want to dollarize the economy across the world. And yeah, dollar is good and everything like that, but attaching yourself to one single currency from that perspective and just going all in from that, and if tomorrow something happens like we all talk about, then we are looking at a global catastrophe. And that is like the first concern. And the second concern that I have is like whenever you hold money, so like let's say I hold dollars, so I have huge amount of USD and everything like that. But the point, what happens is for my day to day, obviously when I am holding US dollars, that's a different thing. But when I'm going out and holding US dollars for my daily go to things, that is a complete different story. Why? Because let's say in India, or like you can say even like forget India, even in the developing countries, when your average salary is like $2,000 to $20,000 a year, and you're holding your money in dollars and it fluctuates 4%, 5%, 6% as per your economy, and that's exactly the inflation rate. And then what happens is you're losing on inflation, you're losing on like the devaluation of the currency, and then these two big problems in any ways are deflating your currency by 10%. And then that means like even whatever you are earning from bank, you're always losing money. And like if you have like like let's say in India you have 10 rupees, I want to buy things from 10 rupees. I don't care about like dollar being like what is the price between INR and dollar, because my expense is in INR. And if dollar is moving, I don't care. And so that is like the two aspects when you're looking at it from an investment perspective. Definitely USD, you can definitely go out and hold if you have trust on that economy. But if you look from a perspective of a daily spend, that is where people are more comfortable holding their own country's currency if they trust their government. Like
Yeah.
that is a big if.
No, I totally agree. I don't think this is a US dollar or not kind of question. I mean, we're at a stablecoin summit, right? So really, it's around how do you think of structuring a stablecoin and how do you make it trusted and safe. And each country will have to make its decision on how it goes about it. I think the cross-border use case is the most prevalent because the fact is that 70+% of trade happen to be denominated in US dollar, the world reserve currency. So that's the easiest for I think merchants to think through. I also want to touch on a point that Ashok mentioned, which is I think really critical, is that stablecoin exists in this world of the cloud essentially, but you need to have real world financial connections, or else you're just playing with funny money, and that's not okay. There needs to be on ramp and off ramp for people to use it on an everyday life basis. So we are fully on board with making sure that there are the right banks, banking partners that we work with. Generally, they are globally systemic, important institutions to help our customers be trusted, be able to on ramp and off ramp. And that's another part where not all stablecoins are equal. Like, are you able, when you want to exit, come out of that stable coin into fiat? And fiat in maybe it's dollar, maybe it's euro, maybe it's rupee. Like, how does that work? Um, that's something that's really important, especially when we start looking at going mainstream, right? Which is where I think if for those who are at token, everyone talked about how do you get to mainstream? Well, you need to have a trusted, regulated stablecoin that has the ability with banking rails connected with real world banks that moves between the fiat world and the blockchain world.
Right. I mean, like the utility is important, right? So it's the first person who accepts your stablecoin is fine. It's the downstream, like how do I pay my electric bill and how do I pay my gas bill? And if they don't accept it, what do I do next, right? And that's the network that we need to build and the adoption that needs to come into play where USDC becomes more of a household name.
This is, and ideally, actually, USDC disappears in the background, but Visa and WorldPay are doing these kind of pilots, right? So there's a merchant acquirer that is working with the merchants. The merchant doesn't really know. You just choose to settle in a dollar-denominated blockchain.
You're getting a plug for the. You're getting paid for every time you plug them.
No, no. What I want to do is be able to, because I think having been at a lot of these conferences, oftentimes it's very, very theoretical. And I want to just bring it down a level to have some real example of like, this is in play today. This is not vaporware of what it could be. Like there are real businesses, large businesses using it, and it takes time to build. And we talk a lot about also in the crypto world that we're building during the winter. The same thing is happening in the Web 2 world. All of those companies, like it surprised me when Fidelity, Charles Schwab, and Citadel Securities launched a non-custodial exchange, right, in the midst of a bear market when they're after FTX, right? Like companies are building, and that's what excites me about what's going to happen in this next phase of growth.
Actually, in the bear market, most of these traditional companies, they didn't fire their Web3 teams. They maybe even invested in their Web3 teams. They maybe paused some of the initiatives on the public announcement side, but they're still building. Also in the carrier industry, we're working still with Deutsche Telekom and Telefonica and T-Mobile, and all of them, they're also building. They, for example, gave a lot away in terms of also the mobile payment business to other projects, also to hyperscalers, to Google Pay and Apple Pay. And this is also a business they want to look into, because for them, they could offer extra services to their users, and they have access to a lot of users, and a lot of these real world utility is happening today on the phone, and therefore also they are heavily looking into what they have to do in that industry.
Right. I mean, the bear market is only for crypto, right? At MasterCard, we really didn't care about the price of crypto. We were more worried about the technology, underlying technology. And in the last 8 months or so, there's been some really interesting stuff which has come out, which we're leveraging and offering these services to our customers. Because we're able to bring in some of those new thought process, because now they're not worried about the price of crypto as much, and they're building some really interesting stuff, which we can actually add on to our platform and then supply downstream to our banking partners.
I think that's a very interesting CEO to see where we are, but for cross-border payment anyway, we have a strong regulation if I go back to the fiat model, which is really in place. And at the end, the people, like you said, on an ecosystem, they want to be able to buy their products on daily. It's what the inflation show as well. So it's interesting to see how the stablecoin can be also integrated with this process, and how it can be accepted by the regulators as well, and how to follow these rules.
Yeah, and maybe our colleague from Polygon can touch on this, but stablecoin is just one part of this next phase. And the other part of building is actually making it easier for users at the end of the day. Not just us, but other companies in the ecosystem are working on account abstraction, gas-free transactions. Like for user, when they're doing a transaction, a normal user doesn't think about, I want to do something here, I got to go buy Matic, or I want to do something here, I got to go buy ETH. And how much is that? Is it $2 or is it $5? And what time of the day? Is Asia open to figure out what the price would be? All of that is now being built to be an abstract away. That for those of you who are using, the trying to grab app here, when you do the transaction, there is a gas fee, but it's invisible to the user. It's all kind of built in, and that's where we need to get to, so that it's the usage of the blockchain is just like tapping and paying, with the MasterCard at a merchant, and the user doesn't care if it's on any blockchain or using Oracle. They don't care.
Marek actually earlier this morning from Cello Foundation was talking about account abstraction and a digital identity linked to the phone number that on the Celo network, you can link a hash of your phone number to your public key and then basically in the end send from phone number to phone number, and also within wallets identify other users via your phone book, via their phone number, and find with this other users in the network, not having to have like a large hexadecimal key anymore, and then like different currencies for gas fees and all these things that you already mentioned. And this is where we're now slowly getting to. And you also mentioned like that was not possible a few years ago when we were still in the bull market, but the product was shit. And now we are in a bear market, but the products are getting better.
And this brings another piece, right? Another key element of this, I know it's not regulatory, but it's identity, right? You know, because more people are using it, how do you start protecting those people? So, you know, to really identify who's receiving and who you're getting, more importantly, who you're getting money from, right? So those are some of the other things that people are focusing on as well, because as people start using this technology more, start moving stable coins around or digitized deposits, whatever it may be, who are you sending it to make sure they have the proper KYC and gone through the right processes? And then on the other side is that if somebody's sending you money, have you gone through the right KYC to receive it, right? So those are some of the other things which are kind of coming into play that we need to kind of looking at too.
This is actually a huge treasure the MasterCards of the world, but also the carriers of the world sit on, basically having the identity of their users and being able to enable them also then using these rails because they are already identified.
Right. I mean, so we can actually leverage a lot of the existing checks that have been done. Like obviously our banking partners do most of the checks, but then we set the governance and the framework to say, well, to access our network, you need to have gone through certain processes, right? And you know, we've created like an allow list functionality to say, well, to use it and move across it, you allow not only allow list of people, but also allow list of smart contracts. So that way the technology which is actually running on our network has also gone through an audit process. And we constantly monitor it both manually and in an automated way to ensure that as technology advances, those checks are being updated as well.
And I think just to add on to what you said, identity, like I think that's really very much important. And like one of the things that we are also working on, and this is like probably like the next thing that we will bring in. So we already have something called Polygon ID, where essentially what you can do is you can actually go out on chain, you can just create Polygon ID, give it the documents from an existing KYC provider. It takes the data and deletes all the document. So on chain you don't have any document with them, but whatever data that it picked up, it attaches to your Web3 address. Now with that, what happens is the powerful thing comes out as like now, let's say in that data, you have the country, you have some essential data about you. And this way, what you can do is, so one of the things and the beauty about blockchains is once your transaction is started, you cannot stop it, right? Which is like in banks, you can freeze them in between. So you have to actually, in order for you to actually go out and ensure that you have to stop something before the wrong thing happens, you have to stop them before the transaction happens, right? And that is where like Polygon ID can become a very good thing, where what you can do is, let's say you want to ensure that the money which is coming out from a USDC wallet, let's say, is not going into some sanctioned countries. So the moment if a person from that sanctioned country is trying to move USDC from that address, it will not let you initiate the transaction. So that becomes like really very powerful in that instance. And one of the things, like another thing that we have, like just like when you set up your Google account, so you have to once set up your Google account, Gmail account, so that next time you can like with one click go and create like your whatever IDs that you want to create. So that is the next iteration that we're working on. So you can just like click, you can just set up your Polygon ID once, have a Web3 address associated to it, and then just click create account using Polygon ID. So that becomes like one add-on, and now you don't have to worry about like how it is happening, what is happening, and everything like that. And regulators are happy because they can go back to the KYC provider who issued this ID to these people and ask if anything is wrong. And also like one just last thing to add on is it preserves your privacy as well. Like you on chain don't know who these addresses are, but the regulators, when the time comes and they want to check, they can do that. So that becomes like that enables instills a lot of confidence into the regulators that, yeah, you want to travel into that uncharted water, you go and travel, but we are looking at you. And if you're doing something wrong, we will know about you.
I mean, that's a good point, right? I mean, like if you look at the new technology, we can actually, as these new regulations come to play, you can actually wrap some of these regulations into the tokens, right? And the regulators don't have to take an active role to monitor every single transaction. They can kind of sit back and say, okay, well, as these rules change, I can just flip the smart contract and have this do it. But more importantly, they can do other stuff, right? Instead of having to monitor every single transaction and just get informed if something breaks.
And actually, this other stuff now becomes much easier and much cheaper, like implement
Golfing.
monitoring, for example. A few lines of code then to have that monitoring on what happens actually with the smart contracts.
What you just described is purpose-bound money, right? This is a concept that's well known, but here in Singapore, the MAS, the Monetary Authority, actually has a project called Project Orchid.
Okay.
Right? And the Grab vouchers is a form of purpose-bound money where you wrap the money token with essentially ERC 1155, and that sets a set of ground rules on where you can spend it. And the government's interested because they deploy so much subsidies, right, to people, whether it is specific to the elderly or for children, for people in low income. I mean, there's just massive use case for this. Places like India has a huge population. They have to think about how do you create targeted subsidies to the right people and less fraud. And purpose-bound money does that. It also help powers e-commerce. There will be some uses around using purpose-bound money where the asset, the money, is paid to the merchant, but it's wrapped until the user, the buyer, confirms that they've received it, they've inspected the goods, and they've clicked yes, and it unwraps on the other side. But the asset is already sitting with the seller. They're not taking on a settlement risk because it's already there.
I think the beauty about that also is nobody knows how it is being handled at the back end, and they only are so to the advantage that you're telling about the government. So government really wants to know where their end money is actually going. Like in India, there's a huge amount is sent, and the government currently, they did a very good effort to ensure that the money that is going out as subsidy is going in the bank accounts. Now I'll tell you how people are going out and misusing that. Why? Because my father works at a rural regional bank. So what some of the, you can say, culprits or these people have done is, before you enter into the bank to encash it, they're standing at the bank gate and they're like, if you don't give me this much of the money that you're getting from the government, we will not let you enter the bank. Now, how does government solve that? And that is where these purpose-bound vouchers come. Like last year, when this was tested out in Orchid, it was done from a perspective to check this only. So there were 2 test runs. The first test was which was in the SFF Summit, and the other was done with the farmers, where farmers were given these vouchers and they were told okay, you can, we are giving this money for you to buy the essentials, and now you have this money in your wallet, but you can only spend that money for that essentials. So now, this eradicates even the last threat, where exactly the money is being used, because now the smart contract is defining where that can be used, and nobody actually can go out and take those lines of codes and say, oh, you need to give me money, then only I'll let you encash that.
These are good points. I mean, vouchers, subsidies, basically fiscal policy toolset of governance now becomes broader, but also the monetary policy toolset becomes much broader if they would adopt the technology. I mean, monetary policy in the past is central banks estimating the velocity of money very broadly, and then setting interest rates for banks and hoping that these banks basically change also rates for the end users. So there's a lot of hope involved in monetary policy and actually a lot of estimates involved. With the technology now, you can have these very targeted subsidies, the vouchers. You can also have a very targeted monetary policy because you also know exactly what the velocity of money is. You can just read it out, again, very cheaply with a few lines of code.
Thank you very much for all these answers, and we see a bit better. We are running a bit out of time, so I would like to have the couple of minutes we have just to ask the audience if you have any question for the please.
Thank you. So we're seeing a lot of regulation so far on stablecoin, but they seem to focus more around issuance of stablecoin. But we know that you can issue a stablecoin in Singapore, but actually most of it is used in Japan by Japanese users. Do you see certain headwinds coming from the government potentially to not just regulate issuance, but if a coin has certain amount of circulation being used in my jurisdiction, you need to somehow be licensed in my country?
I'll take that one. So in the Europe example, in MiCA, they actually have a significance threshold that of a certain size, you get additional scrutiny. So that's one way of thinking about it. In Singapore, you actually don't have to be issued here. You can actually be issued elsewhere. They were very clear in the most recent response on stablecoin rules that you can issue, distribute, deal in stablecoins, provided that you have the DPT license, the Digital Payment Token Services license in Singapore. So you don't have to be issued here. Hong Kong, the Hong Kong took a different approach. Hong Kong had their rules haven't come out yet, but their consultation paper, they were very explicit that as long as you are issuing Hong Kong dollar denominated stablecoin, even if you are not issuing it in Hong Kong, providing it to Hong Kong users, you have to come and talk to HKMA. So they're taking a sort of a I'm the currency issuer approach, and if you're dealing with creation of money on my denomination, you have to come and talk to me. Japan, they have a foreign and a domestic issuance rule. Domestic issuance, you have to be a bank, a trust bank, or a money transmission institution, and they have sort of different criteria for those. And then they have a foreign issue stablecoin way where you can actually distribute in Japan, provided that you have an equivalence of banking and money transmission regulation in your home country, and they'll make that determination. So that's to say, I think there is interoperability being built around some of this. What we expect to see is that we're really in the early stage. We're in phase one of what's happening. Phase one is legal recognition of virtual assets and of stablecoins. Phase two, and probably 2 to 5, is harmonization of some of these rules, because as these become used in the wild and we see real world activity, regulators and policymakers will get more comfortable and then start to see, okay, where do we have efficiency? We don't need, to your point, necessarily 4, 5, or 6 stablecoin in a country of that one denomination. Maybe there is a natural market network effect, and then you start to tailor the rules a bit on how do you then hone in on A, the stability, and B, the user protection, and really fine tune that to the level that's comfortable for each of the jurisdictions.
Thank you very much. I don't see other questions, so thank you for your time and for this speech. And we will let the stage to the other group.
Thank you.
Thank you.
Thank you.